Welcome back to Open Exchange. Where can you find value in the third quarter? Arthur Kemp is economist at Sanlam Investments. He joins us for some more. Arthur, you must have had a very close eye on all the volatility in global markets. Particularly last week, we saw jumps of 2, 3, 4% on the markets and really no clarity on where they were going.
Good morning, David. From an economics perspective, I think what has happened here is a realization that we are in a prolonged, it seems to be a prolonged period of low growth globally. Not only that, it tends to diverge between regions. So the US seems to be bouncing back or has bounced back from its first quarter decline. But elsewhere in the world, there are problems. For example, in Europe, which has very low inflation, and there seems to be a risk of deflation. One isn't sure if that will happen, but there is a risk. High unemployment, plenty surplus capacity. If you have a downturn in demand there now, that would be a significant risk. Also, Japan is disappointed after its VAT rate hike. There was the expectation that the economy would then, yes, have a slide, but start recovering again, and that recovery has been rather poor. And of course, China. Now, China seems to have stabilized its growth rate, but it's also evident that it's at a lower level than we have been used to historically, certainly leading up to the recession from China. So I think the overall realization is that income growth in the world is going to remain quite anemic, and within that there's a divergence between regions.
So Arthur, what type of investment strategy would you use? Of course, keeping in mind everything that you have just said about the different regions and on the back of the medium-term budget policy statement that we had yesterday.
Well, I think the overall conclusion is, certainly again, seeing it as an economist, is that we are in a low income growth period, but also one in which therefore policymakers are going to be quite reticent to pull the rug out from under the economies too quickly. And I think that given high government debt levels, and of course, if a government has a high debt level, it's got an incentive to keep real interest rates low. So a combination of those means that we might be in a period of prolonged low real interest rates. That doesn't mean nominal interest rates are not going to go up, but I think a prolonged period of low real interest rates. So those two things stand out: low income growth environment, low real interest rate environment. And then from yesterday's budget, of course, this indicates the difficulties that governments have in undergoing necessary fiscal consolidation. The reason they have to undergo necessary fiscal consolidation, of course, is certainly if income growth is low, it makes it harder, but their debt levels are very high. So if you have another downturn in the economy, there's no scope for them to implement counter-cyclical policy. So from that perspective, yesterday's budget introduced significant austerity measures. So that means a period of significant consolidation from the fiscus, and of course that over time is a drag on growth. I thought the one important implication of that budget was the burden sharing around. So it's not just expenditure cuts, but there was a very strong hint at the possibility of tax rate increases. Now, why that's important is because taxes have been growing at about 1.3 times nominal GDP in the last couple of years. And this tends to suggest that the tax increases will continue to grow faster than GDP. And of course, in my view, that would have negative feedback effects again on growth. So again, a necessary period of fiscal consolidation viewed in isolation, that is also a drag on growth.
Now, Arthur, you mentioned the consolidation, the austerity. Of course, the question is, as we said earlier on the show, implementation. So how credible is what the finance minister has been saying about what's going to happen? We must remember that Pravin Gordhan, who had considerable weight politically as a finance minister, made similar calls which were often ignored by his colleagues.
I think the more important point here is that I think Treasury have reached the point where they realize there's no more scope, and it was very clear in this budget. They've certainly drawn the line, and they've said we certainly don't want this deficit to slip any further. Of course, the thing this is going to hinge on is government wage negotiations through into next year. Minister made that point very, very clearly, and he said that there's very limited room, if any, for wage increases materially above inflation unless that's matched by productivity improvements. Now, he also indicated quite importantly that if these wage increases do come in higher than expected, and the Treasury cannot guarantee that they will not come in higher than expected, but the minister very clearly indicated that if they do, there would be damage elsewhere, and that damage would be enforced expenditure cuts in other areas. Because unlike previous years where the wage bill was higher than expected, there's not as much scope to run down reserves, etc., or contingent reserves as there was last time around, or anything of that nature. So if we get the higher wage increases, we get damage elsewhere on the expenditure front. I thought in this regard, though, a very important and positive step was the freeze on the number of employees in government, and that may go some way towards helping the cause here.
Arthur, perhaps just to finish off with, if I have an investment basket and I'm looking at the global events and I'm looking at the local events, how should I be allocating my assets? So in terms of equities, how much exposure should I have there? Bonds, fixed income, your insights to that?
I think in this instance, the overall rule and general conclusion one draws is that diversification of one's assets is particularly important, and also to have an expectation that, you know, income return or income growth in a weak income growth environment, your expectations of returns should generally be dampened somewhat. But I think the overriding principle here generally, though, without putting numbers on any other asset classes, is diversification.
Well, thanks very much to Arthur Kemp. He is an economist at Sanlam Investments.